Hey, what's up guys? It's the Average Joe here. In this series, Forex for Beginners, I will be teaching you right from the basics of understanding the Forex market all the way up until strategies which I personally use to trade on the Forex. A quick disclaimer before I start, I am not a millionaire Forex trader, nor do I trade for a living. I'm actually a full-time student and I am just here to share with you guys the knowledge I've gained regarding the Forex markets, with the intention of ultimately enabling you guys to trade on your own. In this video, part 1 of my Forex for Beginners series, I will be highlighting to you guys the power of the Forex market by using a concept which compares trading on the Forex to investing in the stock market over the exact same period of time with the exact same price movement. Also, if you enjoy this video, please remember to like and subscribe, as it will really help out my channel. But anyways, let's get right in.
Scenario 1, the stock market. It's the year 2019 and your friend comes to you and says, hey, we need to make some money. Let's invest in the stock market. And he starts naming some big companies that are performing really well at the time and tells you that they will most likely continue to grow in the future. He has a broker and says he will only charge you $10 to place the trade. Because you are an average Joe and you don't know much about the market, you're an optimistic guy. You decide to give it a try. After watching hundreds of videos on YouTube about the best stock investment, you ultimately decide that your best possible investment would be to buy shares in your friend's business, Jane's fruit business. You go to your computer and you start opening charts. Let me give you a quick brief of what's going on here. What you are looking at is a Japanese candlestick financial chart of Jane's fruit business. These candlesticks are monitoring price movements against time. Over to the right of the chart is the price in US dollars of shares in the company. At the bottom of the chart, it shows the date and time of market movement. The white candles are signifying that the market is going up, and the black candles are signifying that the market is going down. What you are looking at is a daily chart. That means each candle represents 1 day of price movement. Let's just say you decide to buy a stock at $105 on the 26th of August 2019, and then you held onto the stock until its price went up to $110. And on the 16th of Jan 2020, you decide to sell the stock at $110 for some miraculous reason. Maybe you've been watching the news reports, maybe you were reading from a crystal ball, or maybe you actually went to speak to Jane herself. Well, you would have just made $5 profit. Why? Because you bought the stock at $105 and sold it at $110. But since your broker charged $10 commission fee for the trade, you didn't actually make any money, but rather you actually lost $5. But from the beginning, you knew that you would be paying $10 as a commission fee, and so instead of buying one share, you decided to buy 1,000 shares, meaning your investment would be $105,000 and you would be making $5,000 profit. Take away the commission fee of $10 and you made $4,990 profit. That's scenario 1. Scenario 2, the Forex market. It's the year 2019 and another friend comes to you and says, let's invest in the Forex. He has a broker and says he will also charge you $10 to place the trade. Because you are an average Joe and you don't know much about the market, but you're an optimistic person, you decide to give it a try. You go to your computer and you start opening charts. What we were actually looking at is a US dollar against Japanese yen chart. The values on the right of the chart is the exchange rate. Therefore, what you are looking at is essentially the US dollar to Japanese yen exchange rate. What I mean by this is that if you went to the bank and traded $1, you would be getting 105 yen for every dollar that you exchanged. Because the yen is financially weaker than the dollar, what is happening here is that as the market goes up in price, the Japanese yen is becoming weaker in comparison to the US dollar. Let's just say you decided to enter buying first at 105 on the 26th of August 2019 and you traded a volume of 1 micro lot, which is 1,000 units of the base currency in the trade, which in our case is the US dollar. So you are paying $1,000 for this trade to happen. You are literally exchanging $1,000 worth of currency to buy Japanese yen. As the market moves from 105 to 106, it moves 1 point. And on the specific chart, each point is made up of 1,000 pips. And each pip is worth $1 per pip in price movement because you are trading a micro lot. Once again, we held onto our position until the market went up to 110. And on the 16th of January 2020, for some miraculous reason, you decided to exit the trade selling at 110. Well, the market has increased by 5 points by moving from 105 to 110. It has also increased 5,000 pips by moving from 105 to 110. And because this market is paying $1 per pip, you now have made $5,000 profit. Take away the commission fee and you made $4,990 profit. So now if we compare scenario 1 and 2, we can see that in scenario 1, we invested $105,000 into shares and made a $4,990 profit return, which is almost a 5% return. Whereas in scenario 2, we invested $1,000 into the Forex and made $4,990 profit, which is almost a 5,000% return. And we looked at the exact same markets over the same period of time moving identically. And as you can see, the percentage return was much higher for the Forex than the stock market. Obviously, this is a concept and does not take into account factors such as the risk involved. This concept is merely to highlight the investing potential in the Forex, but we can still take this a step further, which brings us to scenario 3, reversing your position. It is the 16th of January 2020, and we just exited trading the US dollar against the Japanese yen by selling at 110 and making $4,990 profit. Now, for some miraculous reason, maybe you have been reading financial reports or maybe you have been looking in the crystal ball again. Regardless of the reason, you firmly believe that the market is about to go down and you want to capitalize on this opportunity. And on the same day, 16th of January 2020, you decide to place a new trade and reverse your position by selling first and buying second. You take $1,000 of the profit you made from the first trade and place a new trade selling the US dollar against the Japanese yen at the same volume of 1 micro lot. The market initially moves down and your trade is looking promising. However, the market starts waving back up and goes as high as 112, and for a while your trade is actually losing money. But because you are the average Joe, and the average Joe believes in himself, he sticks to his game plan, and soon enough the market starts coming down. And eventually on the 6th of March 2020 returns to 105, where he decides to exit the trade buying and makes another $4,990. In total, the average Joe invested $2,000 in the Forex and made $4,990 as the market went up, reversed his position and made another $4,990 as the market came down, making a total profit of $9,980. What this highlights is the trading opportunities available in the Forex market, both as the market goes up but also as it comes down. Whereas in the stock market, this reverse position would not have been possible because you do not have the option to sell first and buy second, because you cannot sell shares if you do not own any.
Alright guys, that's going to do it for today's video. Once again, if you enjoyed the video, please remember to like and subscribe. And if you are interested in trading on the Forex after watching this video, or if you will be following my series, please let me know in the comment section below. Part 2 in this series will be out next Wednesday. Until then, stay safe and strive to be more than average.